Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I am the tax director here at Crest Cooper. Today I've been joined by my colleague Mahar Afzal, and together we will be taking you through today's webinar. The topic of today is the key takeaways from Determination of Taxable Income Guide. So this Determination of Taxable Income Guide was introduced by FTA on 31st of July, and it is giving a very in-depth view of how you can calculate your taxable income. So there's a lot of case studies there, illustrations there, and they have talked about the finer, points. So it is very good for you to go through this. We have already discussed this guide in detail in last week's session. Mahar had gone through the guide itself. So if you have missed that guide webinar or any of the other guides that we have discussed also in our previous lectures, like the transfer pricing guide or the free zone person guide, the tax group guide, and so on, any of our lectures, you can always visit our YouTube channel. The handle is Crest Cooper. And if you have any questions, feel free to email us at info@crestcooper.com. So now coming back to the guide. So this guide that FTA has, if you want to have an in-depth view of the guide, you can visit our last week's webinar. But today we will be discussing the key takeaways from these guides. So we will highlighting certain points from the guide. But the detailed guide, you can see the lecture or last week's lecture of Mahar's. So now the starting point for determining any taxable income is accounting income. So the accounting income is what is there in your financial statements. So the accounting net profit or loss, that is the starting point. This is also called the indirect method of calculating the taxable income, where we take the accounting net profit or loss as the starting point. And then we do adjustments according to the tax law of UAE corporate tax law, and then after those adjustments, we arrive at the taxable income on which the tax rate is to be applied. Now, the accounting net profit or loss for relevant tax period in the financial statement, it can be based on IFRS for SME, or cash basis of accounting. So this depends on certain thresholds given under the law. So, for example, if your revenue is less than 83 million, you can go for a cash basis of accounting. If your revenue is below 50 million, you can use IFRS for SME. If your revenue is more than 50 million, then you have to go for IFRS, and you have to get your financial statement audited as well. If you are a UAE company, you need to get it audited from a UAE registered auditor. So these are some of the conditions in the law. So according to that, these financial statements are prepared. But tax authorities, they after these financial statements are audited and prepared according to where your revenue lies and what applies to you. So they take this accounting income, and then only the adjustment as per law needs to be made on that, and then we will arrive at our taxable income. Now, one thing that we need to be careful here is that when we are doing the calculation for the revenue, for example, the 3 million, 50 million, or is it above 50 million? So you need to be making sure that that revenue, if there is any revenue included, for example, from transaction which you have done with related parties, you've sold to your related party, given services to a related party. So that needs to be on arm length, and then you have to apply and see if this 50% threshold is, 50 million threshold is being met or not. So if you have sold to them at cost, let's suppose, and you are including that in the revenue and saying that, okay, our revenue is less than 50 million, so we'll go for IFRS for SME. So not that, you need to take the adjusted one, the one which is on arm length, and then see where the threshold is, and then prepare your accounting financial statement according to that. So, like for the transaction we do with related parties, there's also transactions we do with connected persons. So, connected persons under the law are owners or officers or directors of the company, or related parties of the owners or officers and director. So, the corporate tax law also requires this, that, like the transaction you're doing with related parties should be at arm's length, and this should also be, the transaction with connected person should also be at market value at arm's length. So any salaries that are paid to connected person, they have to be also evaluated according to this arm's length principle. So how you will do that? So there is no like slabs or rates given under the law. So we need to go for benchmarking studies. These benchmarking studies are done by experts who will, take the size of your company. They use different benchmarking tools that are available in the market. They will see the what is the size of your company, what is the job description, and then benchmark it against different companies of the region, same region, and of the same size, and the same profession, and then take out a benchmark salary, you can say a range, and in that range you will need to ensure that the salary paid to the connected persons of the company is falling in there. So the payment of benefit that is provided to taxable person, it is deductible, but only to the extent that it is corresponding with the market value. So that much would be allowable in the law. Now, accounting depreciation. So right now, the accounting depreciation and tax depreciation is the same for UAE law. Amortization, depletion, and provision, they are all permitted for tax purposes. So no adjustment needs to be made. But in the guide, they have clarified that if a provision is created before a person has become a taxable person, prior to the first tax period, then reversal of that provision after they have become taxable will be subject to tax. So, for example, if a provision was created in 2023 and reversed in 2024, that is when the taxable person got registered and became a taxable person, then the reversal will be taxed when calculating the taxable income from 2024. So when they will be filing this return in September 2025, they will need to take this reversal will need to be taxed in that computation. Now, if a provision is made for an item that is not allowable for tax purpose, so that provision will also be disallowed. So, like for example, if a provision is created for a litigation which is because of violation of law, then that will not be allowed for tax purpose, and it will be disallowed. So fines and penalties, again, if a company has incurred fines for violating the law, for any infraction of law, rules or regulations, that fine is not deductible for corporate tax purpose. For example, fines and penalties, if they're levied by government bodies, it does not matter if they are incurred in the normal course of the business, they will still be disallowed for a corporate tax purpose. You need to add them back in your accounting net profit or loss. Now, example we can take is like company F has paid 20,000 fines that is relating to speeding fines, which are on the company employees. They are incurred during the performance of the employee's work, but they still will not be, allowable because of the nature of the fine, because they are due to infraction of the law or because of violating the law. So they will be non-deductible expenditure. So where the payment of the fine is, it's not fine or penalties, but it is in, you can say that it is relating to compensation, which is paid for breach of contract. So there are certain, exceptions. So let's say that where the payment is intended to provide any restitution for damages caused by, normal day-to-day business operations in that, then that is allowable. So other fines and penalties, a violation of law is not allowed, but this is allowed. So, for example, if any compensation is paid to customer for breach of any contract, that would be allowed, and that you can, then no adjustment need to be made for this. So, for only those fines which are for breach of any law. So, for example, expenditure, if it is relating to breach of customer contract, compensation paid to customer, or professional fee for defending the lawsuit filed by the customer for legal claim, these all will be, deductible for corporate tax purposes, and no adjustment is required to be made. So, only where the fine penalties are for infraction of law or for violation of law, then we need to add them back. Now, let's talk a little bit about interest expense. The general interest deduction rule, it says that if the net interest is the minus interest income and interest expense, so net interest expense would be that. If it exceeds 12 million in a year, or the taxable person can either claim the 12 million or 30% of EBITDA. So if it is below the 12 million threshold, then the rule doesn't apply and you can claim all of it. If the net interest expense exceeds 12 million, then the taxable person has to calculate that is 12 million is higher or is 30% of EBITDA. EBITDA is earning before interest, tax, depreciation, amortization. That is that amount higher. So whichever is greater of the two. Now, how will you calculate this EBITDA? So that we take the taxable income, which we will calculate, in accordance with the corporate tax rules. We will adjust it for the net interest expense for the relevant tax period. We will add back the depreciation and the amortization expenditure for the tax period. Then any interest expense, net interest expense relating to historical financial asset or liabilities which is held prior to 9 December 2022, that will need to be added back. Any net interest expense in relation to qualifying infrastructure projects that need to be added back, and then on that amount, the 30% has to be calculated. That has to be compared with 12 million, whichever is greater, that would be the threshold of how much interest expense can be allowable for the company. Now, if this EBITDA comes out as a negative amount, then we will consider it as zero, and then the threshold for the company then in that case would be 12 million. So if the 30% of EBITDA is greater than 12 million, then we will be considering that. Now, any amount which will not be allowable. So, for example, if 12 million, and if let's say for company A, when we calculate this, the EBITDA, 30% of EBITDA, it comes out as 15 million. So we will compare that 15 million to 12 million, and the greater of that, which will be 15 million, will be allowed. Now, let's suppose the net interest expense, which is the expense for the company minus the interest income and any also the carry forward interest expense that has, we will add that. So we will compare that to this 30%. So for example, that comes out to 18 million. So 15 million is the thresholds which we can utilize. But after that, the 3 million that can be carried forward. And under the law, it can be carried forward for the balance amount for 10 years, which has been not utilized in that period. Now, this carry forward interest will also affect the EBITDA in the future period, and it will be included in the net interest for those period when we are calculating that. And those interest expense that are not subject to this limitation rule, this general limitation rule, they will be fully deductible. And the threshold for 12 million they will not include those interest expense where this general rule does not apply, but it will be added back while we are calculating the adjusted EBITDA to take out the 30%. So for dividend and profit distribution also, in the guide they've said now we know that any dividend or profit distribution is exempt. Now any dividend profit distribution if we receive from a juridical person, a resident juridical person, that is exempt from corporate tax. There are no additional conditions for them. So without any criteria, if any dividend or profit distribution is received from a resident juridical person by a company, it will be exempt. But if in contrast to that, if any dividend is received, let's say from a foreign juridical person, it is also exempt, but it has certain conditions. So the participation exemption conditions have to be met. So for the dividend that you're receiving or profit distribution you're receiving from resident juridical person, they have no condition. So all will be exempt. But for those that are received from the foreign juridical person, that you need to meet the participation exemption criteria first, and then they will be exempt. The capital gains, impairment gains, and foreign exchange gains are also exempt from corporate tax when the participation conditions are again satisfied. Otherwise, they will be subject to tax. So, for example, any dividend if you're receiving from the foreign juridical person, but they're not meeting the participation exemption criteria. So, for example, less than 5% or other criteria they're not meeting, so then they will be subject to tax as well. In terms of tax losses, now a taxable person that has incurred a tax loss, they will be able to utilize this tax loss to reduce the taxable income in the future period. So now let's suppose company A in year 2024, they have tax loss. So now in 2025 or in any other subsequent year when they do have taxable income, let's suppose they have taxable income in the next year in 2025. So they will be able to utilize the tax loss which they incurred in 2024. Now, this tax loss can be carried forward. It doesn't have a timeline like interest of 10 years. It can be carried forward indefinitely, and it can be claimed against the future profit. But the profit, it can only be claimed for a year's profit up to the 75% of the taxable profit. So, for example, if in year 2025, let's say in year 2024, the loss is 100,000, and then in year 2025, let's say the profit is 200,000. So now up to 75% of the taxable income, let's say taxable income is 200,000. So 75% of that is how much, a loss you can take. So if loss is less than that much, you can take the whole of it. If the loss is more than that much, then you need to take only enough that it is a maximum of 75. And then the remaining 25% of the taxable income in the year 2025, that will still be subject to corporate tax. In the tax loss, when we're doing the calculation, any losses that are incurred before the date of commencement of corporate tax, any that is incurred before the person became a taxable person, or any losses that are incurred from an asset or activity that generates income which is exempted from the corporate tax, then those are not considered for this tax loss relief. So also we know that tax losses can be transferred within a qualifying group from one person to the other person and a member of a qualifying group. So what are the conditions for a qualifying group? We have discussed this many times in the past. The taxable persons both have to be resident persons, they have to be juridical person. Either of the entities can have a direct or indirect ownership of 75%, needs to have an ownership of 75% in the other entity, or a third entity has to have a direct or indirect ownership of at least 75% in both of the companies. Financial year of each company has to end on the same date. They need to prepare the financial statement using the same accounting standards, and these entities in a qualifying group cannot be exempt person or qualifying free zone person. So, for example, let's say that you're meeting these conditions and you're part of the qualifying group. So those companies who are in the qualifying group, so one person, taxable person from the group, can transfer its losses to the other person. Now, in terms of the common ownership condition, the taxable person has to meet this qualifying common ownership condition from the start of the tax period in which the tax loss is incurred. So, meaning that if you incur from the time that the company A incurred the tax loss till the time that it is transferred and used by the other taxable person, let's say the company B, when it's utilizing it. So this common ownership condition needs to be met through this whole period from the start of the tax period in when the tax loss has incurred to the end of the tax period in which the transferred loss is utilized by, let's say, company B. And so company A, when they incurred the loss, and company B till the time they utilized it and transfer in between. So the common ownership condition needs to be met in this timeline. The taxable person who transfers the tax loss, they will need to reduce the available tax losses by the amount of by the amount transferred to the other company. So, for example, the company A had tax loss of 1 million, and they transferred 250,000 to company B. So now they need to, reduce their amount of their tax losses, which is 1 million, by this amount, and 750,000 they need to then carry this forward. Transfer tax losses can reduce the recipient taxable income by a maximum of 75%, just like, in the tax loss case, only 75% of the taxable income can be, reduced, and the 100% cannot be utilized. So the maximum that tax loss can be transferred to from company, let's say A to B, would be 75% of the recipient's taxable income in that tax period. So it's not possible to transfer tax loss in excess of the 75. The remaining 25 of the taxable income of that company who's receiving the tax loss will still be taxable. It's the same rule like we discussed for the tax loss, where the company itself is utilizing its own tax loss. It can only be utilized up to 75% of taxable income. The rest 25 is subject to corporate tax. The same way, when you're transferring the loss, so you cannot transfer 100%, of loss of how much the loss is for the other company, who you're transferring it to, how much profit they have. It still has to be 75%, and 25% will again be taxable for them. Now, a single person may transfer their tax losses to more than one taxable person in the group. So if you are meeting the qualifying group conditions, all the relevant conditions, so then if one person has transferred some loss to company A in the same group, they might transfer some loss to company B, or company C if they have enough. And the recipient company, in the same way, they can claim tax losses for more than one transferring company. So it could be that company is receiving loss from let's say company B, company C, company D, and then they can use that much, but provided that, like we said, that it cannot exceed 75% of the taxable income. So if 75% of the taxable income, let's suppose, is 1 million, and so they received from company A 300,000, or company B, let's say 300,000, so only 400,000 they can receive from company C, not more than that. In the future, if necessary conditions are not met, like taxable person is not part of the qualifying group, or there's a lack of continuity of business ownership, the adjusted losses, they will not be reversed, but then in future carry forward, losses or adjustment cannot be made till the conditions are again satisfied. If the transferring company is profitable and has the carry forward losses, then they have to utilize the 75% of these losses first, themselves, before that they are able to transfer this. So let's take an example. Company A has incurred tax loss of 8 million in year one. It can transfer the tax loss to company B, assuming the necessary conditions for transfer are met in year one up to 75% of company B's taxable income of year one. So company A, it has a loss of 800,000, let's suppose, in year 2024. Then it can transfer the tax loss to company B, assuming they're part of the qualifying group and conditions are being met in year one, up to 75% of the company B's taxable income. So like we said, it is a max of 75. If company A has any unutilized tax loss, let's suppose that they transfer 3 million to them and now 5 million is the remaining. So after the transfer, this remaining tax loss will be carried forward by company A to year two, so 500,000. Again, assuming that, all the conditions are being met. Now, continuing from this, now in year two, the taxable income of company A and company B both have taxable income now, 4 million and 7 million respectively. So company A has 4 million, company B has 7 million. Now company A needs to utilize the 75% of its own, loss as much as 75% of its taxable income. So for example, taxable income is 4 million, 75% of it is 300,000. So they need to utilize from this 500 that they carry forward first themselves, the 300,000. And then they can, transfer anything left over to another company, let's say company B in this example. So after they have done their, utilize their share of 300,000, so whatever is remaining, that is 200,000, they can then transfer it to company B. Now this may be, for in this example, company B, income 75% of taxable income is much more than 200,000. So it can either receive, more tax loss from another company, in the group if it's available. But because of this rule, first the company needs to utilize the tax loss themselves before they can transfer it. So the guide also talks about private pension funds. So any contribution to private pension fund are also allowed up to maximum 50% of an employee's total remuneration for the relevant tax period based on actual payment made. So three things are important. First of all, the employees need to be, the ones who are in the private pension plans, their total remuneration. So the maximum contribution is 15% of the total remuneration. Then third thing is that actual payment needs to be made. So all these conditions need to be met for this to be an allowable, the contribution to be allowable expense. So now if contribution has not been paid, it will not be permitted for tax person, even if it is within this limit, even if, let's say, the employees are part of the pension payment plan. Now, let's take an example. As per the financial statement of 2024, contribution to private pension fund is 3 million, out of which 100,000 remain unpaid during 2024 calendar year. The contribution is within 15% threshold. Therefore, of the 300,000 pension fund, only unpaid contribution of 1 million will be disallowed. That means it will be added back. So now the 15% condition is being met. We need to see the other condition, that is it being paid or not. So the one which is actually being paid in this example, the 200,000, that is basically because the 15% condition is also being met and it's paid also, so that will be allowable. But the one that was not paid, that will not be allowable even if it is under the 15% threshold. So that needs to be added back. Now, withholding tax credit. So there are certain credits allowed under the UAE corporate tax law, like withholding tax credit, foreign tax credit. We will discuss that now. So for withholding tax credit, now under UAE law, withholding tax credit has been introduced, and it will apply to certain categories of income which is paid to non-resident person to the extent that it is not, attributable to the PE in the UAE. But so far in the law, they have not, given any category. So we don't know that what those categories of income will be, on which the non-resident will, this withholding tax will apply. And the rate of withholding tax at the moment is given as 0%. So even if the categories are given, in due from a cabinet decision or something, but still the rate for now, for the starting year is 0. But this rate can change in the future. So let's suppose, next year the rate is changed and let's suppose it's 2%. So then a non-resident person who is subject to corporate tax here in the UAE, they will be able to reduce the corporate tax payable by any withholding tax that has already been deducted in the same tax period. So withholding tax will, if somebody has deducted withholding tax from the payments when they're making it to the non-resident, and there is a withholding tax rate in the UAE, and if told us what the categories are, so then any withholding tax paid that can be utilized by them, and any excess withholding tax, it will be refunded. And the guide has also clarified this withholding tax credit will take precedence over foreign tax credit, meaning that we need to use this withholding tax credit before we can use the foreign tax credit. Now, foreign tax credit is the amount of the foreign tax which we pay on our foreign source income, any income which is not an exempt income. So if foreign source income is exempted under the UAE law, then not that. But if there any foreign tax paid on other than exempt foreign source income, so a foreign tax credit becomes available. Now, this foreign tax credit is allowed even if you have paid tax in a jurisdiction where UAE does not have a double taxation agreement. So mostly the UAE has double taxation agreements with different countries, but even if they don't have, then still you can take this foreign tax credit if you have paid on the foreign source income in another jurisdiction. Now, to claim this foreign tax credit, the taxable person has to calculate the foreign taxable income according to the UAE tax rules, and foreign tax will be determined using a weighted average basis. So corporate tax payable will be reduced by any available foreign tax credit for the same tax period. So now, unlike the withholding tax, it cannot be this foreign tax credit cannot be refunded. Now, the amount of foreign tax credit should not exceed the amount of the corporate tax which is due in the UAE on the foreign source income, which means that, for example, the actual amount of tax paid on the foreign source income might be higher. Why? Because, for example, the corporate tax rate in another jurisdiction where you have paid that tax, it might be more than 9%, which is more likely. It could be less also, but more likely that it is higher. So because UAE has one of the lowest, tax rates at the moment. So for example, in other jurisdiction, 15% was the rate. So we will look at, that amount which you have paid and then compare it with the amount that would have been due if, this foreign source income was taxed in UAE at 9%. And whatever is the lower of the both amount that needs to be taken. The rest, whatever is unutilized, then, it cannot be carried forward, like losses or net interest, and like withholding tax, it cannot be refunded. So it will not be refunded, it will be forfeited. And if you are not able to utilize it in that year, so it's basically lost. Now I will hand it over to Mahar, who is going to be just summarizing this lecture and highlight little bits of points from his last lecture on the same topic. So Mahar, I'll hand it to you now.
Thank you very much, Faiza. Thank you very much, and thank you very much once again to the all people who are with us right now. Okay, I think we have discussed most of the item that we have already discussed. We will quickly go through the summary of the guide and important insights that we have. So, a natural person tax period. It has been given in the guide that a natural person will always have a tax period starting from 1st of Jan till 31st December. It doesn't matter whenever this company is registered, whenever you are becoming taxable, it doesn't matter. Might be if you are crossing the threshold of 1 million during the period, or you are setting up a company during the period, but you are always have a tax period being a natural person starting from 1st of Jan till 31st December. Election for the realization basis. We know this if we are preparing, if the taxable person is preparing the financial statement on accrual basis, they have an option to go ahead and adjust the gains and losses and realization basis. There are two options for opting. The taxable person can opt this realization basis for all assets and all liability that are subject to fair value and impairment testing. This is option one. Or they can opt only for the assets held in the capital account, then they will not be opting for the asset under the revenue account. Whatever the option they are taking, it will be irrevocable unless and until there are special circumstances and approval has been granted by the FTA. Payment to connected person, I was personally thinking that might be FTA will bring some sort of guide on it, some sort of slabs on it based upon the revenue, nature of industry, nature of business, based upon the revenue, then it will be quite easy for the people to say, okay, how much should be the salary of the finance manager, how much should be the salary of finance director, CEO, IT officer, ABCD. But now in the guide, it has been written that all the taxable person, they are liable to calculate their taxable income, basically the amount that is being paid to the connected person on arm length basis. It apparently shows that every taxable person will be liable to perform the TP benchmarking study to justify this is a reasonable salary. But still, I believe there should be some sort of clarification on this. Principally, otherwise, it will be very difficult for the businesses in the market if they have around 5,000 employees, how they will be able to justify this is a reasonable market salary. So this it has been given in the guide, whatever the amount that is being paid to the connected person, specifically I'm asking, it will not be applicable to all persons, specifically to the connected persons, officers, owners, and director. These top level people, whatever this is being paid to them, it should be an arm length basis. Guide says we need to perform the benchmarking study. Fines and penalties. If the taxable person is violating the law, any fine or any penalty will not be allowable. But if they are paying any penalty in the normal course of business, this will be allowed. I just wanted to give you an example. Overspeeding fine, this is not allowed. But if the company has made a contract with any other person and there is a breach of clauses of the contract and the company is paying penalty, that will be allowed. Guide says this will be considered expenses in the normal course of business. Carry forward interest, Faiza, she has already explained in detail. I would just like to highlight that carry forward interest will be considered in the adjusted to calculate the adjusted EBITDA for the next year as well. What is the reason for this? Because the guide says, law says, net interest should be adjusted to arrive at the adjusted EBITDA. Whenever we are calculating the net interest, they said carry forward interest plus current year interest expenses, then current year income. So carry forward interest will be part of the net interest, and net interest will be adjusted from the accounting income to arrive at the adjusted EBITDA. So this is the important thing. The two impact will be there for the carry forward interest. First, it will be considered in the adjusted EBITDA. Second, it will become a part of the overall net interest to apply the threshold. Dividend, as Faiza said, dividend from the local juridical person exempt, non-juridical person, foreign juridical person exempt subject to participation exemption condition. Other than this, participation exemption revenue. So dividend, this is tricky. Dividend, either you are receiving from the local, sorry, dividend, if you are getting from the local juridical person, this is exempt without any condition. But if you are getting the dividend from the foreign juridical person, that is exempt subject to certain conditions. And if I'm asking participation exemption related to any income or gain related to participation exemption, in this case, either you are receiving from the resident juridical person or you are receiving from the foreign juridical person. In both of the cases, participation conditions are applicable. So if I'm summarizing, if you are receiving dividend from the foreign juridical person, or there are any income or any gain related to the participation exemption, conditions are same. Only in one case, if you are getting the dividend from the resident juridical person, then there is no condition, it will be straightforward exempt. Now, expenditure incurred in relation to participation exemption, apple to apple comparison, like to like comparison. If the income is not allowed, you cannot claim the expenses as well. This is simple rule, apple to apple comparison. Contribution to private pension fund. This is not allowable subject to two conditions. When this is allowable on payment basis, maximum 15% of the employee's total remuneration. So if you are not paying or the amount is more than 15%, in both of the cases, you will not be able to claim. Suppose your total contribution is more than 15%, straightforward, you cannot claim. If the total contribution is less than 15% of the employee's remuneration, then you need to apply another test. And the second test is, have you contributed or not? If you have contributed, then you will be able to claim. If you have not contributed, merely on declaration basis, you will not be able to claim. Foreign PE exemption. Important thing is you can opt for the foreign PE exemption, but tricky thing is if there are any losses and you have adjusted any losses in the past, first you need to offset all those losses, then you will be able to opt the foreign PE exemption. Otherwise, you cannot opt it. Expense is capital in nature. If you are claiming, suppose you are buying machinery, you are claiming in the profit and loss account as an expense, you are arriving at the taxable income, loss is no, this will not be allowed, it will be added back. You will be able to claim only depreciation, only amortization. Otherwise, you will not be able to claim straightforward expenses. An important thing is, if you have capitalized any expense, they have given example in the guide. Suppose you bought one machinery, then litigation was going on, and you have capitalized the litigation cost as well. Litigation is some sort of fine or penalty. This fine, this penalty is being capitalized. So any depreciation, any amortization related to this portion of the capital asset that related to penalty, you will not be able to claim that portion. Rest of the portion you will be able to claim. Multiple expenses. If you have exclusive any expenses exclusively for business purposes, you can claim 100%. If you have any expense which is not exclusively for business purposes, you cannot claim. If there any expense, this is multiple purposes. Some portion is for business, some portion is for non-business. Then the question arises, can you apportion this? If you can apportion this based upon the allocation key, based upon the cause and effect basis, based upon the benefits derived basis, if you can allocate it, then the portion that related to the business, that will be allowed. And if you cannot apportion, it has been given in the guide straightforward, you cannot claim that expenses to arrive at your taxable income. Employees being paid cash or consideration is in kind. It doesn't matter if you are paying them cash, if you are paying them consideration, it should be based upon the arm length principle. If anything beyond the arm length principle, authorities will not allow you to claim as a deductible expense. Expenditure not allowed. Related depreciation not allowed. I think we have already discussed this point. If the expenditure is not allowed, like I said, legal cost, you have any paid any fine penalties, but you have capitalized those fine and penalty. Assuming asset cost was 100,000, 10,000 was the penalty or litigation, you have capitalizing 110,000. If you are amortizing, you are depreciating 110,000 over the period of 10-year, monthly depreciation will be 11,000. They said 10,000 you can claim, 1,000 you cannot claim, because this pertains to the penalty where you have violated the law. Pre-incorporation and pre-trading expenses, 100% you can claim subject to the condition these are booked in your financial statement as per the applicable accounting standards, or cash basis if the amount is less than 3 million. Provision allowed for legal payment only. Provisions are allowed, as further discussed, provisions are allowed, bad debts written off allowed. But if you have created any provision before entering into the tax era and you are reversing those provision after entering into the tax era, the reversal of the provision will be considered taxable income and you will be liable to pay tax on it. Amount withdrawn by the business. A lot of people still asking this question. If the employer is taking any salary, will it be allowed for tax purposes or not? They have given further clarification. It depends you are running a business as a natural persons or LLC, limited liability company. If you are a natural person or juridical person, if you are a natural person, this is straightforward. You will not be able to claim whatever you are taking, because exactly it has been written in the one more guide. Whenever this is a natural person, if you're taking any money from the business, it will be considered that you are taking money from your one pocket and you are putting in your money in your other pocket. They will never ever allowed for tax purposes, because in the eyes of the law, natural person and this business as a sole established is a one entity. There's no difference in between this. So amount withdrawn from the business by natural person who is a taxable person or partner in unincorporated partnership. Unincorporated partnership is also a natural person. In both of the cases, if you are a natural person, you are withdrawing the salary, it will not be allowed straightforward, because there is no difference in between the natural person and the individual. Local taxes, they said if you are paying any municipality property taxes, yes, this is allowed, you can claim it. But if the banks are paying any taxes at the Emirates level, it will be considered Emirates level tax. It will not be allowed for tax purposes. Entertainment, as further discussed, for employees, you can claim 100%. For non-employees, 50% is allowed. Tax losses, as we discussed, tax losses you can adjust maximum 75% of your taxable income. Remaining 25% will be subject to tax. Might be this is the same taxable person, might be the person to whom the losses has been transferred. If the person to whom the losses has been transferred, that person income up to 75%, you can he actually they can adjust, and remaining 25% will be subject to tax. And this tax losses depends upon certain condition. And we all know this continuity of business and continuity or the continuity of ownership. If there is no continuity of business or there no continuity of ownership, then you cannot carry forward the losses. But these condition, continuity of business or continuity of ownership, is not applicable for the natural person, because natural person is the self owner of the business. So continuity of ownership condition is not applicable on the natural person. Adjusted losses cannot be reversed. I think I have discussed in the previous webinar as well. You have adjusted the losses for assuming for the 2, 3, 4, 5 years, because losses can be carried forward for unlimited period of time. If you have adjusted the losses for few years, after that you are not meeting conditions, so whatever the losses that you've already adjusted, it will not be reversed. But future losses will not be allowed unless and until you are meeting respective conditions. Cash basis of accounting has no balance sheet. We all know this, that receipts and payments, receipts, income, payments, expenses are actual receipt and actual payment basis. So cash basis of accounting has no balance sheet. Withholding tax, as I has already discussed, withholding tax credit, it will take priority over the foreign tax credit. It will be allowed to arrive at the final tax payable. Foreign tax credit, this is important. Foreign tax credit, you can claim maximum 9% of the relevant taxable income of the foreign person. If you have paid any foreign tax credit more than this will not be allowed to arrive at the taxable profit. Foreign tax credit cannot be carried forward. Foreign tax credit cannot be carried back. You will forfeit it if they're extra. Just look into this example. I'm not going to discuss any further illustration. I will be discussing only one illustration related to the foreign tax credit. Okay, just look into this. This is an example. I'm not going into the detail. Basically, just you can say this is a company. This company has a UE company. They ask a foreign PE establishment. This is exempt income 5260. This is the exempt income. This exempt income they are arriving. This is the tax accounting income. Then they have made their adjustment. We have already discussed that. Whenever you are considering the foreign tax credit, first of all, you will have to calculate the taxable income of the foreign PE based upon the UE tax law. So based upon the UE tax law, you need to calculate the foreign taxable income. So this is the basically the accounting income. There is only one adjustment of 2 million. Then they arrived. This is foreign taxable, foreign income exempt income is 5260. This is the exempt income, foreign exempt income. Now they have made some sort of adjustment. Then the overall company, this is taxable income 15 million. These are the adjustment. After arriving at the adjustment, this is the taxable income. This is the taxable income of the UAE resident company. This taxable income, if I'm asking what is the tax on this taxable income, the tax on this taxable income is 1312650. Now, how much foreign tax credit we need to take? This is the question. How much foreign tax credit we need to take? Law says 9% of the taxable income of the P of the resident juridical person, or whatever the taxes they have already paid out of the UE, lower of this will be allowed. So maximum 9% of their taxable income you can claim, remaining will be forfeited. So how will you calculate 9% of their taxable income? It is in the guide they have given one formula. This formula is basically foreign taxable income. divided by total taxable income of the resident juridical person, multiply the total tax payable. So if I'm asking, so this is my total taxable income, this is my total taxable income, and this is my foreign taxable income. This is my foreign taxable income. 5260 is my foreign taxable income. So foreign taxable income 5260 divided by total taxable income. Total taxable income is 46960. So 5260 divided by 14960 total taxable income, multiply the total tax payable. Total tax payable is how much? 13. This is the total tax payable. 1312650 multiply 1312650. So foreign taxable income, foreign taxable income, foreign taxable income is 5960, not 5960 divided by 14960. So 5960 divided by 14960 total income, multiply total tax payable 1312650. So credit maximum allowed is 522,954, whatever they have given here. They said the company A can take the maximum credit of 522,954. They can take the maximum credit. How much tax they have paid out of the UAE? They paid total tax of 726,000. The company has paid tax out of the UAE 726,000, but they can take a credit maximum 522,954. So how much they have paid? 726,000. So how much tax they has been forfeited? Forfeited tax is 203,045. Their tax has been forfeited. This is 203,046, this is 045. So whatever the basically crux is, foreign tax credit is allowed maximum 9% of their foreign taxable income, and we can calculate this foreign tax credit by applying the weighted average technique. How much foreign taxable income divided by total income, multiply the total tax payable. Remaining tax will be forfeited. It cannot be carried forward and it cannot be carried back. Thank you very much. This is over from our side. I think we have discussed almost everything related to this guide. And if you have any question, you are most welcome. Few questions are here. First question is dividend from a non-resident juridical person is subject to tax. 5% participation exemption condition is not met. Dividends from non-resident juridical person is subject to tax. 5%, yes. If the participation exemption conditions are not met, the question is basically if they are getting dividend from the foreign juridical person and participation conditions are not met, so what will be the treatment of dividend? Dividend will be straightforward subject to tax, because if you are getting a dividend from the foreign juridical person, then if the conditions are being met, it will be exempt. If the participation conditions are not being met, it will be subject to tax. Second question. Tax deducted at source for that dividend can be considered for tax credit. Tax deducted at source. Yes, if the dividend, apple to apple comparison, if the dividend is subject to tax, the whatever the tax you have paid out of the UAE maximum up to 9% they will allow. Remaining it will be forfeited. Because if you are not considering the dividend, you will not be able to claim the withholding tax, whatever you are paid out of the UAE. If you are paying tax on the dividend, it has become your taxable income. And if you have paid any tax on that taxable income, you will be able to take foreign tax, you will be able to take basically the withholding tax credit. Sunita is asking if business accrued income in the financial end is 2023 and reversed in start of 2024. There is accrued income in the financial year 2023 and reversed in 2024. Raised tax invoices for that same in 2024. So till the accrual is taxable. Okay, it all depends. You are following the cash basis of accounting or you are following the accrual basis of accounting. If you are following the accrual basis of accounting and you have accrued the income, and this will be subject to conditions of IFRS 15 or 16, whatever is applicable. If those conditions are being satisfied, definitely you would have accrued that income. If you have accrued based upon the conditions of the IFRS are being satisfied, then that income will be considered income in the previous period. And if you have reversed in the current period and you have bought it on actual basis, whatever the reversal, if the reversal is resulting in income, that it will be subject to tax. We have already discussed. One more question: if the provision has been made for any expenses at the end of financial year 2023 and reversed in the start of 2024, booked actual bills, is provision is still deductible? Okay, if you have booked a provision of 100, your actual expenses are 90, 10 will be subject to tax, because 90 they will allow, 100 you will reverse. 100 will be your income, 90 will be your expense, 10 will be subject to tax. And if your provision was 90, actual expenses are 100, so you will be able to claim 100 and 90 will be reversed. So this is very straightforward thing, I think. One more question. Can you also please share PDF? Okay, send me your email address. I will share the PDF as well. One more question. Can a owner salary be part of expenses irrespective of their visa, either investor or employee? If yes, how much? Owner salary, it all depends upon the status of the legal status of the taxable person. Taxable person is a natural person or juridical person. Natural person not allowed, juridical person allowed up to the market value. Suresh is asking a hypothetical situation, please. Hypothetical, I think this is a very straightforward thing. This is not a hypothetical situation. Anyway, if your specific question, if the entity is a branch of a foreign company, if the entity is a branch of a foreign company, the residence branch in UAE incurs all expenses of the employees like salaries, travel, rental, whereas the income is in the books of HQ following a group management control policy. No, you need to segregate it. Expenses are being booked here, income is being booked somewhere else. What are the expenses are being booked here? These expenses needs to be recharged to the group by applying the arm length principle. So if your expense is 100, you are recharging to the group, assuming 110, 10 will be your taxable income. How will the local expenses be treated with respect to the CAT? Local expenses, as I mentioned, you will be required to recharge to the respective party. If you are incurring the expenses for your 100% for your own business, you will be able to claim 100%. If you are centralized resource, centralized station, excellence, center of excellence you establish, from here you are serving all other destinations. So you need to charge to the respective destination based upon the allocation key, cause and effect basis, benefits that is being provided to them, and you need to apply the arm length principle. You will be required to perform the benchmarking study for this. One more question: company registered in DMCC and doing 100% out of scope. Registered in DMCC, doing 100% out of scope, trading free zone to free zone, trading free zone to free zone, trading free zone to free zone. Okay, transaction can be considered as a free zone. Will CT applied? If you are a qualifying free zone person and your all conditions are being satisfied, the sixth condition to become a qualifying free zone person. If you are qualifying free zone person, all the conditions are being satisfied, then if you are selling goods to other free zone person who is the beneficial recipient of the goods and de minimis threshold is not being breached, then your income will be considered zero rated income, not out of the scope income. You will be liable to submit the return, register yourself for corporate tax purposes, but at the time of submission of return, instead of 9% tax, you will apply 0% tax. Hamza, I got your email address. I'll share. Suresh, thank you very much. Thank you very much, guys. It was nice speaking to you and have a lovely evening. If you have still any question, and you can drop us an email. You can contact us. I am there. Faiza is there. Shahid is there. Anwar is there. Rest of the team members are there. We are always happy to support you. If you have any question, you are most welcome. You can drop us an email at info@crestcooper.com. you can give us a call as well. Thank you very much. Thank you very much, Faiza, and have a
Thank you.
lovely
Thank you,
evening
everyone.
to everyone.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.